Welcome back. So the cues across Asia are pretty mixed. We've been saying that a lot of the markets are, blinking red and green. The Chinese markets are actually doing pretty okay, considering they're at the center of the whole, tariff talk and tariff storm. Look at that. The Hong Kong market's up about 1% at this point in time. The mainland Chinese market is also higher. Let's pull up the implied open and see what we are getting. It's, there we go, about 62 lower. So going more with the caution on the implied open. Let's get down to individual stocks. Plenty of names to track. And as always, we have our team standing by with the CNBC-TV18 list of top stocks for the morning. Guys, good morning to all of you. Yash, let's open with you. LIC numbers, how do they look?
Well, Survi, as far as LIC is concerned, there has been degrowth across parameters on a year-on-year basis. But I'm still going with green on the stock. That's because if you compare it to what Street was anticipating, the top line has been a miss in terms of total APE and the retail APE, but the operational performance in terms of value of new business and margins have come ahead of Street estimates. The Street was anticipating a higher miss on the margins, but the miss on the margins is much smaller than that, about 64 basis points. The margins have come in at about 19.36% versus 20%. This is one reason. The second reason is also the fact that the stock has corrected significantly. It's down 33% from its 52-week high and trading at its 52-week low. These are the two reasons why I'm going with green on the stock.
Okay, all right, going with green out there. Thanks a lot for that, Vivek. Well, let's, for that, Yash, let's hop across to Vivek. He's here to tell us about NHPC and Tech Wabag. Morning, Vivek.
Well, good morning. NHPC, it's a very mixed quarter. A lot of one-offs, a lot of provisions that the company has made, and some key projects commissioning that was awaited continues to be in limbo, and that is something that the Street continues to await clarification on. However, the core hydropower generation in the months of October, November, December were quite strong, which led to a revenue growth of almost 11.3%. Multiple one-offs, but however, EBITDA up almost 36% on a year-on-year basis. Margins 44.7 versus 36.6, and profitability impaired or marred by one-offs, especially much lower other income at 330 crore versus 495 crore. Profitably went down 50%. Now, the other important aspect to keep an eye out for was the interest expense. The interest expense this time around was almost 5.5 times higher at 650 crore, and this was at the back of multiple adjustments that the company paid. Prior period employee expenses of close to 200 crore and arbitration claims of close to 100 crores. Going with the green only on the back of the fact that there was some growth seen as far as hydropower generation is concerned, but the Street will be worried about commissioning of key projects. Now, coming to Tech Wabag, let's put this particular company into two separate developments that we are tracking. The first one is the results itself, and the second one is an order inflow update that the company has given. Let's have a look at the results. Top line grows. However, the Street will be slightly worried about the margin compression that the company has seen even compared to Q2 as well as Q1. Revenues higher by 15%, EBITDA up almost 1.5%, but margins at 12.4% versus 14%, profitability higher by 11.6%. Now, the order book at the end of Q3 stood at 14,200 crore. Now, very interesting, yesterday the company announced that as part of a consortium, the total consortium won an order of a little over 3,250 crore. Now, this is for an independent sewage treatment plant and has come from Saudi Arabia. Remember, in December, the company had lost a large contract. Given the fact that they've received one more contract from Saudi, it will assuage a lot of investor concerns. The management will be joining us later today, and we'll get a lot more details, especially as far as the order inflow outlook is concerned from Saudi as well as India.
Well, as Vivek said, thanks Vivek for that. 9:50 is when you'll hear from the management of Tech Wabag, so stay tuned for that. Well, Oil India and Amara are going to be the other companies in focus. Sud is here with details. Good morning.
Good morning, Prashant. So for Oil India, it was an all-round miss. Revenue was down 0.1% versus expectation of an increase. Even EBITDA has slipped 2% versus an expectation of 12% rise. And because of that, margin has slipped to 40.7% versus expectation of 46%. The reason? Crude realization has fallen 7% sequentially versus expectation of 1% fall, and crude sales were down 2% versus expectation of increase. Even apart from weak earnings, even company has cut FY25 crude production target. Now it's expecting crude production at 3.48 to 3.49 MT versus earlier target of 3.60 MT. So that's the reason I'm going with red for Oil India. Second is Amara. Company has reported operationally weak set of earnings. Margin has slipped below the targeted level of 14%. Now, adjusted profit was down 21%, EBITDA was down 4%, and margin has come in at 13.1% versus 15.1% in the same quarter last year. And company says margin was impacted due to fuel and power purchase cost adjustment recovery that was approved by Andhra Pradesh Electricity Regulatory Commission, and that has led to increase in electricity expenses, and that was the reason margin was impacted. And because of that, I'm going with red for Amara as well. So both red for Oil India as well as Amara.
Okay, it's not looking too good for these two in the third quarter. Got it, Sudarshan. Thanks very much. Let's move on to Fortis Healthcare. Vinny is tracking these numbers. Vinny, morning, looking healthy?
Absolutely. A strong set of numbers that has come in from the company in Q3 of FY25. Strong growth in terms of revenue, 15% growth. Margin seeing a very good expansion of around 250 to 300 basis points. So yes, the expansion mainly in margins is also something that is leading to a strong operational performance. Now, revenue growth, why is that seeing such a good growth? The hospital business, which accounts for more than 84-85% around of the revenues, has done quite well for the company. They've seen a good growth in ARPOB also of around 9.9% for the hospital business. So all in all, good numbers coming in from the hospital business side. Occupancy, that has improved to 67% versus 64% last year. International patients revenue has seen a growth of around 17% to 132 crores, as well as the focus specialties of the company. So neuroscience or robotic surgeries, that has also seen a good growth. That is better margins for the company as well. If that sees a good growth, that leads to an improvement in terms of margins. Both of these have improved by neuroscience has seen a good growth of around 23%, while robotic surgeries has seen a growth of 77% on a year-on-year basis. So good performance on that front as well. And diagnostic business, that's a bit subdued, but that continues to see recovery, and that is what we're watching out for. We're expecting green for Fortis Healthcare.
Okay, all right, Vinny, thanks a lot for that. Let's hop across to Vamakshi. She's going to tell us about Honeywell's numbers. Vamakshi, a little bit of a subdued set?
Well, absolutely, Nigel. A weak set coming in for Honeywell. When you look at the revenue, that's on an uptick of only 2% on a year-on-year basis. This is much lower than what the street was anticipating. The cost of goods sold has seen a much higher jump of almost 14%, putting pressure on the margins. EBITDA margin has seen a decline of almost 198 basis points to 13%, and the net profit too is seeing an uptick of only 3%, but most of this uptick in the net profit is being driven by other income, which saw a very sharp jump of almost 78%. But overall, when we look at the numbers from Honeywell, a weak set it's a miss as compared to street expectations. In addition to that, there's a note that came in from Novama. They say that intense competition, persisting supply chain challenges, and adverse product mix continue to be negative catalysts for the company. They've gone ahead and trimmed their FY25, 26, and 27 estimates by 7%, 8%, and 9% respectively. And given that they've retained a reduced rating on the counter, cut their target price to 36,675 rupees per share. So overall, I'm going with the red for Honeywell.
Okay, all right, got it. Vamakshi, thanks very much for that. Let's now head across to Mangalam to figure out if delivery has been on the mark or not. Mangalam?
It's actually not been on the mark. Delivery this quarter hasn't delivered, which was a seasonally strong quarter. Remember, e-commerce companies see a lot of business, but that has been eaten into by quick commerce. So delivery, the revenues were absolutely, feeble at around 8.5% in terms of growth. Remember, typically in the third quarter, the company shows mid-teen sort of growth, and that's reflected in the EBITDA as well. It's been flat. Margins have come off by 70 basis points. The net profit, yes, it has increased. It's doubled on a low base, but that's largely because depreciation has come down. And the company, remember, 2 quarters ago had changed their depreciation method. So as a result of which, the depreciation is actually lower by 66 crores. If you add that back, then even the net profit has shown a decline. What is the key disappointment out there? Express Parcel, which accounts for nearly 2/3 of their revenue, their shipments grew just 2.4%, and the margins came down from 20% to around 15%. The company did try to manage that with the other business, which is the part truckload business, where tonnage increased by 16.5%, and we also saw margins improve. But that's too small a contributor right now to mask the weakness that we saw in express delivery. So see some red on delivery today.
All right, Mangalam, thank you very much for that. Well, Firstsource is the next one in focus. Reema is here with details. Reema, morning.
Hi, good morning. So the key highlight is the company has raised the full year revenue forecast. So Q3 has been good on the top line, 8% quarter-on-quarter revenue growth, a near 30% jump year-on-year, margins expanding to 30 basis points. But as I said, FY25 revenue growth forecast has now been now stands at 22% at the midpoint versus 20% earlier, and margin guidance has been retained at 11 to 11.5%. Back to you.
Okay, all right, Rima, thanks for that. Well, let's go back to Vivek. He's here to tell us about Religare. Vivek, good news coming in.
Well, good morning. Quite a lot of uncertainty actually has dissipated as far as Religare is concerned. One of the biggest worries, or the main agenda, in fact, as far as the AGM was concerned, was one of the points on the agenda on which shareholders were expected to vote, which was the reappointment of Dr. Rashmi Saluja as the MD, CEO or as the chairperson. Now, what's actually happened is that amidst high drama, eventually the voting has taken place, and as per the votes that was uploaded to the exchanges last evening, 97.53% of the total voters actually have rejected the reappointment of Dr. Rashmi Saluja. Now, what this means is that, number one, most likely she will have to move out of the company. Now, the second important development that has taken place is that the Supreme Court has actually asked the Berman family to go ahead and extend their open offer till February 12th. This is basically to pave way for, number one, giving Danny Gaikwad enough time, the competing open offer, to go ahead and put 600 crore as earnest money. However, this does not mean that the open offer has been approved as far as Danny Gaikwad is concerned. There are multiple regulatory approvals that are required, including SEBI, IRDAI, CCI, as well as Ministry of Finance. So one key part of the puzzle has gone. However, the open offer continues to remain in limbo, whether or not Danny Gaikwad's open offer goes through or not.
Okay, all right. So let's see. The open offer battle still seems to be on, though the question of Ms. Rashmi Saluja, maybe that's been settled. At least that's what it looks like for now. Vivek, thank you very much for the details over there. Let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them are LIC, NHPC, Tech Wabag, Fortis Healthcare, Firstsource Solutions and Religare. The ones that have negative news around them are Oil India, Amara, Honeywell Automation and Delhivery, largely on the back of disappointing Q3 numbers. Okay, so that's our equity list for the morning. Let's move on to commodities now. We have Manisha joining in with the roundup of all the action. Manisha, good morning and happy Monday to you.
To you too, Zurvi. Thank you for that. Well, I'll start with the crude oil prices because we are back above $75 a barrel for the Brent prices there. Well, there are new U.S. sanctions on Iran crude exports. That is keeping the prices higher. And then the U.S. may announce new global tariffs on steel and aluminum today. China tariffs on U.S. goods also take effect today. So there's just a lot to deal out with, and that is what is keeping many of these commodities on the higher side. In case of tangible commodities, you have base metal prices also trading firm. Copper is trading at a 4-month high. We've seen copper prices gain up by 7% in the previous week, which was the best weekly gain since the month of September. And then you have to take a look at the gold prices also. While we have seen an all-time high of 2886 an ounce, it's trading around 288.80 right now, so not too far away from its all-time highs. The easing policies from global central banks and China perhaps could follow with retaliatory tariffs today. There's just so much uncertainty that's keeping safe haven buying continuing in case of gold.
All right, Manisha, thank you very much for that. Absolutely, lots of uncertainty, and the price of gold keeps going up as a consequence of that. We'll take a quick commercial break here. We're going to come back. Prakash Diwan will be with us with some fundamental stock conversation. We'll also be we'll also have the management of PG Electroplast join us a little after that. Stay tuned.